Hello, and welcome to Money Mystery No More. Our prior episodes got into money and several money concepts involving money benefits of risk management. Please watch them and continue learning even more money benefits of risk management as we discuss college 529 funds, debt consolidation, and even a little estate planning. You will continue to get the most out of this video by zeroing in on how those concepts apply to your situation and how your own money might benefit directly with risk management by keeping it simple. It's awesome. And remember, hit that subscribe button to keep getting the latest and greatest information. Okay, let's remove the mystery. Our video, Money Benefits of Risk Management, and the follow-up video, More Money Benefits of Risk Management, covered money's evolution pretty well. Not rehashing that detail, money still has a fascinating evolution in the United States. Paper currency itself really stems back to the Revolutionary War in 1775 as a means of financing the war. Though that didn't really work out, it was done again during the Civil War. Change occurred in our system and currency over time as we now have U.S. mints, the Federal Reserve System, and the U.S. Secret Service. Those entities did introduce counterfeit measures, consistent portraits, emblems, and monuments on the front and back of the bills, our great inscription, In God We Trust, those really large presidential pictures, and even high-tech microprinting. You are encouraged to watch both of those videos because money touches our lives on a daily basis, and a little history never hurts. We also covered the concept of risk management before, but a fast recap reminds us that you need to protect your finances and its economic value by mitigating exposure to risk. That is done with deliberate risk management strategies involving actions or plans designed to help manage financial risk incidents. If those incidents occur, they cause negative, unwanted stress to your financial situation. To avoid that, 4 common risk management strategies are put in place. First is risk avoidance. To identify threats, determine the chances and damages, then take steps to avoid and deflect those threats. Second is risk reduction, which minimizes the actual damage to your personal financial situation by reducing risk factors. Third is risk transfer. This transfers your financial risk of damages to another party, like insurance. Then the fourth is risk retention, with you assuming all risk to pay for all losses. Yes, a fast recap, so you are encouraged to watch our prior related videos, or even embracing risk management with financial planning. Again, most of that was covered in our prior related videos. In fact, all of these concepts are featured videos of this channel, Money Mystery No More, so continue to enjoy our broad money-related content. Meanwhile, let's get into another money concept most of us deal with, debt consolidation. Sometimes in life you have situations when there are more bills than money at the end of the month. Those bills include loans with high interest rates and fees, which in turn start costing too much as the balance climbs or the amount being paid down each month is too low to make an impact. This is most common among credit card balances and car loans. You constantly feel a nagging pressure on the wallet, your nerves, and the quick escalating balances. Fortunately, there's a common solution involving debt consolidation. This process allows you to repackage the multiple various loans into just one single loan and payment. The goal is simple: get one loan with better terms, including a lower interest rate. You pay off all the other loans, which have high interest rates and poor terms. This helps you manage your debt more effectively, assuming you maintain the payments and don't take on any new debt. Plus, an amazing bit of stress is lifted when only one bill is involved. Let's look at a real-life scenario you may be able to relate to. And note, we'll be making some assumptions. 1. You have a spouse or significant other. 2. You each have a vehicle loan and monthly payment. And 3. You each have 1 or more credit cards with a monthly payment. Let's assume these debts total $62,255 with the monthly outlay of $1,684. All else being equal, after you pay it all off, your principal and interest paid would be $78,743. Now in this first example, if you were to get one 48-month loan at $60,000 and an interest rate of 10.25%, your new $1,529 monthly payment is a $155 decrease with a 48-month total savings of $5,352. That's a lot of money. Note we used a $60,000 new loan because the effective date of the new loan would likely still require one more payment on the old debt. So for the second example, let's just say your credit score was a little stronger and you got a little bit better rate of 9.15%. That does not sound like much, but comparatively, your monthly payment goes to $1,497, saving you $187 each month. Even better, your total savings in 48 months would be $6,869. Sounds great, right? In both scenarios, you save a significant amount of money. That is real money that you could certainly put to better use, perhaps for your Roth IRA, new clothes, new tires, or even a lunch cooler. You get the idea. Most people pay bills as part of a monthly routine, so debt consolidation works. The money benefit of risk management in this case is usually reduced stress, less quantity of bills, and lower overall payments. This is a huge win because your monthly cost and your total long-term cost are reduced due to one lower interest rate on one total balance versus multiple small debts with higher balances and/or interest rates. And speaking of long-term cost, how about college costs? If you have the desire to help yourself or someone else with future educational costs, there are some College 529 plan options offering risk management against inflation of the constant escalating tuition costs and education-related expenses. A 529 plan helps offset that cost because you can start saving very early with low contribution amounts. Eventually, you'll be able to withdraw funds tax-free for eligible expenses. There are basically two types of College 529 plans in use. There's a prepaid 529 plan, which is more rigid because they are typically only used for public in-state college programs sponsored by the state itself. If your beneficiary wants to go somewhere else, the funds may be restricted. In fact, it's highly likely their options will be slim because most states don't even offer a prepaid plan. For those that do, the student is typically required to be an in-state resident. Making a prepaid plan even less compelling is the usage restrictions. Normally, if the beneficiary doesn't go to a higher level institution, the funds may be difficult to transfer, even to a sibling, without incurring high fees. Participating schools usually restrict plan monies to tuition cost and related fees while excluding room and board. On the flip side, the prepaid plan does offer lower tuition rate guarantees in the future, along with some tax advantages, making them favorable for fighting inflation. That's because the fund owner prepays the tuition and fees based on the current market rates. Plus, funds do enjoy tax-free growth along with tax-free distributions for monies used on qualified expenses. Still, prepaid plans are fairly restrictive and should be carefully weighed before committing to one, which is why most people opt for a College 529 tax advantage plan instead. With this type of plan, the benefit of low contribution amounts, tax-free growth, and tax-free withdrawals still exist, but there are several positive differences with this plan. The money can be used for more educational-related expenses at nearly any college, university, some trade schools, any public, private, religious elementary or secondary school, and the expenses include room and board. There are more options to include graduate schools, vocational and tech schools, colleges with 2- and 4-year programs, and even those located outside the U.S., as long as the school is accredited for financial aid. Other family members and friends are allowed to contribute. All states allow investing into this type of plan. While contribution funding limits may vary, there are no income limitations. You won't lose the money due to easier transferring options. Non-qualified withdrawals are possible, and the fund owner can even get money back from the plan if the beneficiary gets some sort of scholarship funding. There are a lot of reasons to choose a College 529 tax advantage plan. It clearly enjoys more money benefits of risk management as compared to the prepaid plan. Now, onward with quite a different money concept, estate planning. Unlike debt consolidation and 529 college funds, preparing for your future death is not necessarily exciting. Clearly, it's important and needs to be planned. In fact, if your death were to happen today or tomorrow, are your assets and money getting handled the way you want them to be? Planning for that event properly does offer money benefits of risk management. Your estate is the total of all your assets and possessions that you value. It's your heirlooms, photos, furniture, car, artwork, firearms, or that favorite coffee cup. Your estate may be small, but it's still yours. It might be literally just the shoes on your feet and the clothes you are wearing. But still, you have the right to decide what happens to your shoes and your clothes. When you cease to exist, perhaps you wish your assets are handled and passed along a certain way. You accomplish that with estate planning. You get the ultimate say on who gets your assets, what happens with your assets, what happens to you if your health or mental capabilities fail, and how all those things happen. Ironically, it's a time in life that your wish is your command, because estate planning offers you the process of making plans for the management and transfer of your estate after your death using a will, trust, insurance policies, and/or other devices, at least according to the most common definition of estate planning. You'll still need to get a complete list put together of everything you own to start the planning, and deal with your medical needs and handle several financial decisions, and handle your asset transfer, which is basically you legally directing your assets to specific entities or people in a lawfully binding manner, which typically adheres to your will, living will, and/or trust. Someday estate planning will be factored into your money concepts and risk management. It's a big topic and fortunately covered in great depth during my video, Essential Estate Planning Provides Peace of Mind. Check it out. This conversation, like those before, involved many concepts and the money benefits of risk management. Keep learning more as you embrace subjects relevant to your own situation and applying more money benefits of risk management to your personal situation by keeping it simple. Remember, hit that subscribe button and turn on notifications so you keep getting the latest and greatest information from Money Mystery No More. I'll see you in the next video.